The euro fell sharply overnight as traders poured over Europe's trade deal with the United States and saw a 15% tariff slowing its economy. That's coming up in our 5 Things in 5 Minutes on Tuesday, July the 29th. And then in our deep dive interview, ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at how the Reserve Bank of India could deal with surplus liquidity in the banking system.
The problem goes beyond the central bank, i.e. that the government has to take some steps to revive demand in the economy, to strengthen it so that it encourages people to borrow more and use up this liquidity.
But first, in 5 and 5 with ANZ, European and US stocks swung back and forth overnight as investors and traders sifted through the detail of Sunday night's 15% tariff deal between the US and Europe. An initial rise in European stocks faded as traders saw the tariff rate for exports, the average, rising from 1% to 15%, which would slow economic growth. The Kiwi and the Aussie fell too, after Donald Trump said he was considering a 15 to 20% tariff range for all other countries, which in theory would include Australia and New Zealand, who are currently expecting 10% tariffs. Here's ANZ economist Sanjay Mathur.
The answer to who won and who lost in this trade agreement isn't straightforward. On the one hand, the effective tariff rate on EU exports to the US is set to rise from around 1% at the start of the year to over 15% following this deal. Now, this will exert pressure on businesses as they adjust to the new tariff rate. But on the other hand, the 15% tariff rate means we have avoided the worst possible outcome, which was 30% tariffs as President Trump had proposed earlier.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.2%, having been up in early trade, and the Nasdaq is up 0.1%. The 10-year US Treasury yield rose 3 basis points to 4.41%. Gold fell 0.8% to $3,366 an ounce, while West Texas oil futures rose 2% to $66.61 US a barrel. The US dollar index rose 1.1%, having risen 1.1% to 1.1586 US dollars to the euro, and it was up 0.6% to 148.53 yen. The Aussie dollar fell 0.8% to 65.13 US cents, and the Kiwi fell 0.8% to 59.68 US cents. Number 2. Bansi says Europe's economy will feel the chill, but not fall into a recession.
So broadly thinking about, the implications for the euro area, we think the 15% tariff rate will pose headwinds to the growth outlook, but is unlikely to push the economy into recession. So downside risks to growth outlook is something that the ECB is also worried about, and that is one of the reasons why we have in our baseline forecast a 25 basis point of cut from the ECB at its September meeting. For the US, average import tariff rate is likely to now stay in the 18% range. President Trump mentioned that he's considering setting a tariff rate for rest of the world, which could be in the 15 to 20% bracket.
Number 3. The yen also fell versus the US dollar overnight, which ANZ's head of FX strategy, Marja Ben-Zaman, says is partly due to its tariff deal and a likely hold this week by the Bank of Japan instead of a hike.
It's still going to weigh on exports. So there is a growth impact that's going to play into the GDP numbers in Japan. So it's hard to see the BOJ aggressively normalize rates in a quick way. So there is a risk that the hikes could get further delayed. So that doesn't help any upside for the yen itself. And furthermore, of course, yen has also got the other property of a safe haven flow. And, as we spoke about it, risk sentiment is pretty positive. And as a result, again, no impulse for a stronger yen there in the near term.
Number 4. Malaysia's government has announced a stimulus package, including a 100 ringgit per adult cash payout. That's about $25 US, plus a 6 cent a litre cut in petrol prices. ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, says the package is worth about 0.14% of GDP.
It will not move the needle greatly, but at the same time, we should recognize that private consumption in Malaysia has held up reasonably well. The outlook is undoubtedly cautious. And we should also raise the fact that exports are in a very uncertain environment. So therefore, a little bit of support to the household sector is useful. The other thing is that with the direct cash assistance to Malaysian adults, I think they have to spend this money between August and the end of the year. So most likely they will spend it rather than save it, and that should give some boost to consumption.
Number 5. In New Zealand, jobs data for June from tax records was soft, with growth for the month of just 0.1% and total jobs of 2.34 million being down 27,850, that's 1.2% from a year ago. Here's ANZ New Zealand senior economist Miles Workman.
So with the household labour force survey data out for Q2 on the 6th of August, which is next week, this data does suggest some downside risk to our employment forecast of 0.1% quarter on quarter, and therefore downside risk to the Reserve Bank's forecast of 0.2% quarter on quarter. So we haven't put our preview out just yet, but the signal from these data are things are looking just a little bit softer than we've been expecting in terms of employment growth.
Miles Workman there. Now, in our deep dive interview, ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, explains why surplus liquidity in India's banking system is a problem and what the Reserve Bank of India might do about it.
Yes, so I think in a simplistic sense, banks, as in any other economy, are required to keep a certain proportion of their deposits with the central bank in the form of reserve requirements. When they exceed this amount, and particularly in periods like this when the excess amount is huge, that refers to excess liquidity in the banking system, which generally is then parked with the RBI or the central bank in some form or the other.
And why is this a problem? Because you've got some charts in your note which talk about a significant increase in that liquidity surplus over the last 6 months or so, and it's well above the levels that the RBI has set as its preferred target.
Excess liquidity by itself, and particularly at this point in time when inflation is quite low, is not a problem. But what it is symptomatic of is bigger problems in the economy, i.e. that the credit offtake by the private sector is much weaker relative to deposits. And at this stage in India, it's not as if deposit growth is unusually strong. That is also quite weak, but credit is even weaker at this point in time. So that is really the core of the problem we have in India right now.
So what's the Reserve Bank of India, what's its situation? What should it look at doing?
Well, I think what they really need to do is to cut interest rates further, which we do expect one more rate cut in the next few months. But I think that the problem goes beyond the central bank, i.e. that the government has to take some steps to revive demand in the economy, to strengthen it so that encourages people to borrow more and use up this liquidity. And that will give you a multiplier effect on overall growth conditions.
And what sort of things could the government do to increase demand for credit?
There are twofold. One is sort of more direct fiscal measures, welfare-related measures, incentives to invest. And then the second part of it really relates to a broader reforms agenda by which, we really continue to sort of look around the issues of labor, around land, so that we get a more wholesome improvement in growth, whether it's consumption, whether it is investment. But these are things that, take a long period of time to fructify.
And is the household sector and the corporate sector able to handle more borrowing at this stage? Are there any sort of balance sheet restraints?
At this stage, there is some restraint on households, and that really comes about in the form of the fact that, one, wage growth hasn't been great, employment hasn't been great, and at the same time, households have increased their leverage. So I think it's about 42% of GDP, but this form of leverage isn't particularly healthy either. For example, some of the media reports that close to 3/4 of iPhones are now bought on credit, and that's not a good sign. We would want to see it more to go towards mortgages, etc. So that is one set. But what it also means is that overall demand conditions, when you don't have strong income growth, are not particularly sanguine. And that sort of feeds into corporate activity, i.e. corporates don't feel the need to expand their capacity. So it's a fairly uncomfortable nexus that seems to be forming between the household sector and the corporate sector.
So what do you think the Reserve Bank of India will do, therefore, in the coming months through to the end of this year?
I think that they will continue to cut rates, particularly as inflation has been on their side. So we do expect one more rate cut at 25 basis points. And this follows a series of rate cuts we've had at the beginning of the year. So the central bank will obviously do its part. Where we are worried is that in the absence of proper government support, rate cuts by themselves may not deliver the desired results.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 29th. Catch you tomorrow with a preview of the Bank of Japan's decision later in the day. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.